we are really getting to a point right now where the market's plumbing is speaking to the tightening. I wouldn't say the overall tightness. There's still ample reserve, but there's 25% roughly of the banks that are already at or near their most comfortable reserve levels. And that to me tells me something. So I would say the next 10% is really where I'm watching. Like if we hit 30, 35%, that's where I'm starting to get like much more significantly worried about what's going on.
How do you play this as an investor or trader?
Bob Sheehan is the founder of Lighthouse Macro, where global macro, monetary mechanics, and market technicals converge.
His sharp, data-driven insights guide hedge funds, CIOs, and central bankers while staying clear and actionable for every investor.
And I think now macro and crypto, Bitcoin cannot be separated if you want to do it well. Given the connection of stablecoins to the funding markets, to the auctions, to the short end of the curve, you are now having a direct transmission between crypto and the treasury markets. And so that's where you are starting to see this risk of heightened volatility.
Hey guys, welcome back to Less Noise, More Signal. I'm pleased to welcome today Lighthouse Macro.
Yeah, no, thank you so much for having me. I'm excited to be here. Talk about some funding markets, treasury markets. Excited to be here, and I think what you're doing is awesome. You're bringing out some really unique thinkers, and I'm excited that you tapped me for this one.
Yeah, I had to, because you've been popping up on my timeline as well every now and then, sharing these really interesting Substack articles. We'll surely link to your Substack in the show notes. And there is where I got a lot of the things that just interest me from. And I thought like, okay, this guy, I need to bring him on because he's one of the guys. Maybe some of the people might not know you yet, but I guess you will, if you keep on putting out this content, you will explode because people are sort of searching for that type of content. So very nice to have you on. If you could quickly introduce yourself, why have you been talking about financial plumbing? Where do you come from? And then also, what is Lighthouse Macro in a nutshell?
Yeah, sure. So where I come from, I come from a background in portfolio management on the buy side. I was doing both multi-asset global portfolios as well as a macro-based equity strategy, really looking at things from the top down and figuring out how things move and then pairing that kind of with the more traditional analysis. And then I spent some time on the sell side, both selling macro research and helping to find new indicators for the buy side and selling kind of new and differentiated products. And then I was fortunate enough, I went back to school to, kind of really hone my data science skills. I'd gotten the CFA and the CMT and kind of have a more traditional finance background. I'd studied finance and economics, but I really wanted to kind of sharpen my data skills. And I really think that's kind of the area of the future where you can really gain an edge. So while I was doing that, I got reached out to by a macro hedge fund, and I was able to help them out for a while in producing research. So Lighthouse Macro started while I was back at school. What we are and what we seek to be is just really a data-driven macro strategist, somebody who prepares the data and tries to be kind of unemotional about the whole thing and just take what the data is giving us, prescribe what we think is most likely to happen in the future without being hyperbolic, without going over the top. I try to find measured approach, but also stuff that people aren't necessarily looking at, right? A couple months ago when I first was touching upon the funding markets and what was going on within the plumbing, I don't think a ton of people were really looking at it. To me, I just saw this kind of thing bubbling on the horizon, right? And I wanted to kind of get the word out and just share my thoughts and share the data that people might not be as familiar with. And so that's what I'm trying to give people with Lighthouse Macro, is bringing the data that not everybody is going to either have the time to look into or maybe not the knowledge to dig into it, and bring that in a way that, people can grasp and understand why it's affecting them and why it's affecting their portfolios and why they should be paying attention to it. So yeah, that's kind of me in a nutshell.
Nice. Yeah. And as I said, you've been putting out these insights for sure. And I guess that's also what we want to talk about today as well. So you can surely bring some valuable things here to the table, I guess. I mean, I want to start there, like everyone and your mom is talking about the imminent end of QT, quantitative tightening. And some say it could end as early as October, others point to December or even maybe March 2026. What is your take? Why is everyone talking about it all of a sudden again? And yeah, what's your take?
Yeah, so I think obviously Powell came out this week, and he's talking about, they may stop shrinking its balance sheet soon, saying that QT could end in the coming months. I think the end of October would be a little early, but I could definitely see it happening by December, or starting to happen in a meaningful way. I mean, just this week we saw on Wednesday the banks borrowed $6.5 billion from the standing repo facility. That was pretty much the largest move we've seen outside of month-end moves. And we are really getting to a point right now where the market's plumbing is speaking to the tightening. I wouldn't say the overall tightness. There's still ample reserves, but the tightening of the markets right now. And I think we're getting to a place where they understand that if they do too much more themselves, they're going to put extra stress on kind of the system, on the plumbing itself. So I do believe that the ample liquidity we're still at a point where it's reasonable. It's still, okay. And there's no need to hit necessarily the panic alarm, but it's time to take notice if you haven't been. And that's kind of really what we've been trying to get in front of people, is like, this is time to be paying attention to this. The Fed's clearly paying attention to it. I think market participants, even yesterday, I just noticed this past week, there's been a lot more talk about this. And I think people are starting to kind of wake up to it, but maybe not fully appreciating kind of the era we're in, so to speak. So I just think right now is the time to kind of focus on this plumbing and bring in this part of the entire system into your analysis. And I think it's an area that people should be focusing on if they aren't, especially with kind of the evolution of the entire space. And I'm sure we'll get into that more. But yeah, I just think with the Fed, with what's happening just in the actual mechanics, you're at a point in time where you can't ignore it anymore, I believe. So,
Yeah.
well, I think today it's kind of prime to be focused on.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yes. And if you speak of a tightening liquidity, you are referring to bank reserves, like eventually, right? This is what's tightening, so to say. And when you talk about the ample reserve system, this is also a term I think a lot of people have heard, but maybe you can refresh our memory on this as well, what it actually means, and then why bank reserves are so important. That would be great.
Sure. Yeah. So when reserves are scarce and financing gets more expensive, right, you're going to have fewer buyers kind of willing to step in, and you're going to get a place where there's more stress on the funding markets, on the system. We have obviously the U.S. Treasury markets are the deepest markets in the world. They are the primary spot for collateral, easy collateral that is safe, that is known for throughout history as being a place where you can come and fund your other liabilities with other trades, with well-backed collateral by the U.S. government, right? And so I always believe that the interest rate markets, the U.S. Treasury markets, is where everything should kind of start and stop. And right now, we're at a point where you're starting to see less reserves are coming down, right? And you got the TGA has been rebuilt. You're having the overnight reverse repos have come down to single-digit billions from their highs of trillions back a few years ago. And you're at this point where there's starting to have some symptoms of this scarcity. And again, we're still, as I would kind of diagnose it, in the ample liquidity regime, but we are fast coming to pay attention to this right now. So as of like the latest is, I think we're at 3 trillion in reserves, which sounds like a ton, but it's coming down, and we're seeing that it's about 800 billion above the cushion. That sounds comfortable again, right? These numbers are so big that people are like, oh, we're fine. But when you look at it, like there's 25% roughly of the banks that are already at or near their most comfortable reserve levels. And that to me tells me something. That's a quarter of the banks right now that are hitting kind of their reserve stress points. And once that starts happening, that's where you have to really watch for contagion effect and watch that ballooning. And so I think we're at a point where it's time to really turn our gaze to this, and not be alarmist about it, but just kind of take it in as stride. You're like 25% to me, it is a meaningful amount of the banks that are under pressure right now. So go on, please.
Is this mostly then also the regional banks, that have been starting to see some weakness again just in recent days? Is it mostly these banks, I guess, we're struggling?
So yeah, those are definitely the kind of the premier candidates that are struggling at the moment. You're not going to hear your JP Morgans and Bank of Americas of the world that are struggling with this yet, but it starts there, right? It has to start kind of somewhere in the system. And when you start seeing stress across the regional banks, and we saw that as funding stress picked up this week, as spreads blew out this week, we saw regional banks down across the board, kind of from an equity standpoint, as people started to kind of price that in. And so, yeah, it does start there with the kind of the less regulated capital structure banks, the regional banks, but it eventually could absolutely bleed if policy isn't changed, if something isn't done. And so that's kind of, it's time to focus on the smaller banks now, because that's going to bleed over. Once you have to have the bigger banks stepping in for that, then what happens after that? Then who has to step in for them if things start to fail? So I just think, it does start there, and then it kind of bubbles upward.
Yeah, exactly. Ultimately, it might be the Fed that needs to step in and will have its hand forced. I mean, ampleness of reserves or scarcity. This is something that you referred to as well. And you said, like, in aggregate, these reserves, they just dropped below 3 trillion, I guess, I think early October. But then my question is, where is sort of the line in the sand? I think you mentioned the level as well. And then also, how do we quantitatively measure whether reserves are ample? Is it just that we look at the total of reserves that are in the system and we compare it to history, where we've seen maybe in 2019 that there was stress? Or can we also compare it to the total assets that banks have on their balance sheet and then see, okay, if this gets out of hand, so any data points that we can look at here?
Yeah, so certainly I think I would say a combination of what you just brought up. So you want to look at history, obviously. That's going to be one of the best guides you can possibly have, and just see, are banks at levels that we've seen before? Are they reasonable? What else is going on? And sort of understanding that. And then, understanding relative to their own assets, how much they have in reserves and how comfortable they are right now, how big of a buffer they have relative to their assets, and especially if you know their asset mix, whether they can fund that and really support that kind of reserve drain that we're seeing right now. So I would say it's really a combination of all of those. We finally dip below that 3 trillion mark, as I said, for the first time in years, and we are 800 million above the minimum. That's decent enough, but we really would like to see that more, and especially from a percentage of the banks. I would say, if you start to get, we're at 25% right now, roughly. If you start to get, 50% of those banks doing that's, I would say, extreme. So I would say the next 10% is really where I'm watching. Like if we hit
Mhm.
35%, that's where I'm starting to get like much more significantly worried about what's going on, and think that there's real pressure on the system. So it's a combination of all the factors, and I think there's always going to be moving parts. But really, you're going to want to look at history. You're going to want to look at the banks themselves, and really apply the metric versus what they have on their balance sheet, what they're able to
Yeah.
kind of fund, what they're capable of, and then the broad just view of across the markets. That 30%, 35% level is where I would start to kind of really get a little bit more stressed about the situation.
Self-custody is one of Bitcoin's greatest strengths. And to truly benefit from it, you need a hardware wallet built with seriousness and world-class security. Enter Bitbox. Bitbox embodies privacy, precision, and uncompromising quality. It's incredibly user-friendly, yet powerful enough for advanced users. You can connect it to your own Bitcoin full node, fine-tune your own transactions with advanced coin control, and even add an optional passphrase for maximum protection. It's also fully open source, echoing Bitcoin's core principle, don't trust, verify. And while not all of us can verify every line of code, trust here is built on something real. I've known Bitbox's core contributors for years, and I've come to trust their expertise and integrity. So if you want to secure your Bitcoin like a pro, go to bitbox.swiss/LNMS, order your Bitbox now and get 5% off. Again, this is bitbox.swiss/LNMS. Yes, and I think some people are also looking at this metric like SOFR compared to interest on reserve balances, where like if this is getting out of hand, or let's say like SOFR is that much more above the IORB, then this also sort of signals stress. Maybe if you could flesh this out as well, what is this telling us as well?
Yeah. So we saw it spike the other day. We saw it spike, almost to 20 bips ahead. I think the GC repo rate hit 4.36, I believe, at its height. And whereas, the effective federal funds rate was somewhere around 410, 415 area. So we're seeing these spreads blow out, and that is stress in the system. You're seeing people needing more to back up their credit risk that they're taking, people needing more to fund their overnight borrowing. And so when we see these spikes that aren't at the kind of month end, quarter end movements, that to me signals, pretty significant moves. This was, one of the biggest spikes we've seen in years, especially outside of major events, COVID back in 2022. And so you have thresholds, 8% or 8 bips, 10 bips, but this spiked to nearly 20 bips, and that makes me sit up a little bit and focus on that. You have to be aware of what else is going on, but when you're seeing that happen, you're seeing stress that isn't normally applied, right? That isn't really happening in the pipes on a day-to-day basis, on an average basis. So these spikes, I think the way I think about them is it's a great tell that I should be focused on this. I should be looking at this right now. And we are seeing it right now pick up in a way that we haven't seen in some time. And it all kind of congregated around Powell's speech. And we've seen these kind of dominoes, all these triggers happening in the funding markets that I think all of us should be paying attention to.
Yeah. I mean, why is it happening now? Because you mentioned it yourself, there's like quarter end, there's month end, where sometimes we have some repo volatility and stress, but now we're into October and it seems to persist. Is it also in some way maybe connected to the government shutdown, that's been going on? Because that's what I heard some people argue, because then government nowadays is a huge provider of liquidity in the economic system. And if it's shut down, nothing is flowing into the private sector, so to say, from their big pocket. Is this affecting this situation and making it worse? Or
Yeah, so I think absolutely. I mean, it's definitely not helping, right? Anytime the government shuts down, you're going to get a little bit more nervousness in the system, generally speaking, just because of the fact that some of the systems of government aren't operating right now. And when that's true, then that all ties back to what I was saying earlier, that the treasury market is still the deepest, most trusted, safest, quote unquote, asset base in the world. And anything that's tangentially related to that, and the government is obviously very much related to that, it is going to put extra stress on it. So I would say that's a huge part. I would say also the shift away from monetary world that we were in into kind of a fiscal dominated world too. I think we're seeing just kind of dislocations broadly. I think that's going to play out kind of in the funding markets, in the plumbing. There's no magic number and there's no kind of magic formula, but when multiple of these things fire off at one time, that tells me that there's more going on than maybe the eye would normally see. And it tells me that everything that's going on externally with the government, everything that's going on kind of in the shift of what's driving the world forward right now, is affecting, people's confidence in the system, and that maybe we're starting to see the early stages of cracks form.
how do you play this as an investor or trader? This is usually because I've been hearing a lot about this, but then it's usually qualitatively, or you have people like you who are sharing around numbers, and then, but like you being a money manager, or you said you used to be like a portfolio manager. I guess you still do manage money. Like, how does it feed into your framework to actually, where you actually like manage money?
Sure. Yeah. So I would say the framework starts with, treasury type trades. For in one of my earlier pieces, I noted a bear steepener where you're kind of getting the shorter end. You're seeing those yields spiking, but you're not having as much demand on the long end. So it for me, the way I think about it is what are we witnessing in the funding markets, and then how is that affecting along the curve, right? And is it the belly? Is it the front end that has the bid right now? Is it the back end that is kind of starved for attention, so to speak? And that's the way I come at it to begin with. And then from there, I kind of want to find out what's the duration profile of that original thought around treasuries, and then apply that to the equities. Whether, if I'm liking long duration, then I would want to be in the tech names, especially right now, given everything that's going on from there. But yeah, it would really, for me, it would start and end with trying to figure out what the curve's going to do. And I will say there are invalidations to the original thoughts of kind of what is going on, right? So I firmly believe that risk management is going to be key. It should be first and foremost in all money managers and kind of trade ideas. But starting from a bear steepening is well and good. You have net issuance still remaining elevated. You're having dealer balance sheets lag. You're seeing repo spreads normalizing higher. We're not only we're seeing spikes, but we're kind of seeing them normalize and drift higher. But then on the other side, you have to be prepared. If there's a sharp drawdown in the plumbing, if stablecoins, if we see them kind of get taken back very quickly in some capacity, if we see heavy month of coupon supply combined with kind of no improvement in auction internals, if we continue to see auction internals deteriorate, all of that is going to then potentially unwind that trade. And right now we are seeing some of that bear steepener come back to us. I do think kind of longer term and or tactical frame, that is still the way I'm thinking about it. I do think we're going to see a re-steepening, and especially when you get these kind of moves that are very dislocative, and you're seeing these big swings on an intraday basis. That's actually, when I would be adding to that position and kind of piling in.
Yeah, it's very interesting because obviously some of our listeners know I'm a money manager as well at the bank. I mostly manage like the crypto side of things, but Bitcoin and digital assets. And there, obviously, I was wondering, like, if I had just waited for, I'm looking at the system, reserves still seem to be somewhat under stress, but they're ample, as you said. The line in the sand is whatever percentage you have it to be, but then you're like, okay, I'm not there yet. And then you don't wind down your trade. Like with Bitcoin, obviously, you would have done quite badly in the last few days,
Yeah.
and so maybe it is, and with equity, not, because they have maybe not reacted that much as of yet, just because, as you said, things are still okayish. They are maybe a little deteriorating, but it's not at like full on stress levels. And crypto is maybe just because it's mostly liquidity, or like the biggest liquidity sensitive play out there, it has already reacted, even though we were sort of still quote unquote far away from hitting a real scarce reserve system. So this is probably also how you have to think about it in terms of the asset classes, right?
Yeah, absolutely. I mean, I would say you nailed it when you said Bitcoin is so tied to liquidity, and really this trade is going to start from liquidity out, and that's where you want to tie in the assets that are going to care about it the most. Bitcoin right now, and I think crypto in general, with the stablecoin phenomenon, honestly, that we've seen the past few years. And honestly, it feels like almost daily we're seeing new headlines about stablecoins coming out, new highs in total market cap, stuff like that. I think you're going to want to start every trade around this thesis, around kind of the liquidity drying up to some degree, about the ampleness becoming less ample. You're going to want to tie it back to that liquidity, and how close and how functioning of the asset class is based on the liquidity. Bitcoin's going to be huge for that. We saw it, take it on the chin past few days, back below its 200-day moving average. Now you're starting to get a technical play involved, which might have the ripple effects of then feeding back into funding and creating feedback loops where people are starting to be more stressed about their positions in Bitcoin and unwinding trades through stable coins. And then, so I think it starts from there and kind of moves out. Like you said, there hasn't been a ton of shock really yet in the equity markets in terms of, major dislocations that we saw in the spreads, that we saw in the uptick of usage for the reverse repos. But it's always going to start liquidity out, I would say.
Yeah. In that sense, Bitcoin is almost like the canary in the coal mine, like where it is so upstream that, like my read on the market is, if Bitcoin has corrected from 126 now to 103, and this almost seems like it's trying to signal that if things don't get better and keep on deteriorating, then we really might get an actual liquidity problem in the system, where equities would probably be drawn down as well. And so maybe, as you said, things can be turned around, and then everything is going to be fine, and equities aren't hit that hard. But that's probably how I would read it. So I don't know if you have any thoughts there.
Yeah, no, so I definitely do. And I think, like, I will admit, even a couple of years ago, I wasn't paying nearly as much attention to Bitcoin as I should have been in terms of the crypto market in general. And I think now macro and crypto, Bitcoin cannot be separated if you want to do it well. And I think a large function of that is the liquidity proxy, and how serious, big institutions are taking crypto, and you're seeing crypto treasuries popping up all over the world right now. And so I think it's absolutely the canary in the coal mine. I think it's something you have to pay attention to, especially given that still the majority of stablecoin usage is to fund trades in Bitcoin and other crypto, but Bitcoin still being, almost 60% of the market cap for the cryptos. It's going to affect all of that. And you bring up a good point, like the further away you move from the actual source of liquidity into equities, that's when you start to see the ripple effects and kind of the dominoes of this liquidity stress. And it does take time. And that's kind of why I try not to be overly alarmist, but I do flag these as something to pay attention to, right? And it's when you start seeing it in Bitcoin, that tells me, okay, then there's other people who are noticing this as well. And if that starts to ripple in, if you start to see it meaningfully in the equity markets, and especially those who are tied to Bitcoin or tied to kind of the crypto space, the technology space, that's when it tells me that liquidity is a fear for investors right now. They're starting to be less secure in their positions. and they're quicker to pull back and go into cash and get stable. So yeah, I think you're absolutely thinking about it the right way, and that's the way I come at it as well. And that's why I think these markets, as maybe esoteric or kind of under the surface as they may be to some people, I think they matter now as much as ever. The crypto boom has only made that more pronounced.
Yeah. Yeah, sure. I want to lead into this, your little treasury market outlook. You had these very great pieces, I think 3 in a row, sort of like where you explained your outlook on the treasury market and where we're going from here. And obviously there's been a lot of talk about the changing face of treasury demand as well. Can you flesh this out for us? Who is actually buying more and who's selling and offloading?
Sure. So the buyers, it's been shifting for some time, but it's starting to become more pronounced. Buying more than used to be, right? You're getting more money funds being buyers, money market funds being buyers, more fund managers in general being buyers. And we're also having the stablecoin bid that was very recent and becoming more and more important every day. In terms of buying less is the traditional buyers, which is we're seeing this massive shift. The traditional buyers being the banks, being the foreign buyer base, whether that is foreign central banks or foreign investors of various demand. Those were kind of more elastic holder, or those were more natural holders. We're moving into a place where we have more elastic holders who move with the price and who move with the yield, and they feel more. It's making the entire treasury market more fragile. Again, it's not yet a crisis, but we are seeing it rotate pretty significantly. Like stablecoins are only a couple percentage of the overall buyer base right now, but compare that to a couple of years ago, they were less than that. They were, basically zero. And we're seeing foreign buyers step back in a pretty meaningful way, to the point where primary dealers are having to step in pretty significantly into these auctions and kind of put themselves on the line and take that risk. They are, forced buyers, so to speak, and rather than the natural buyers of years past. And so it's not necessarily about the levels. The way I always try to think about it, and for all of this stuff really, is it's not about the ultimate absolute level of what's happening. It's about the change in the historical kind of framework of how people have historically analyzed and viewed these markets. It's shifting underneath. And I think that is going to play a bigger and bigger role throughout the coming years. And as we see the treasury demand shift even more, if we see even less foreign buyer demand, if we see less demand from China, that's going to be meaningful to what we see in actual auctions and what we see kind of in treasury markets, generally speaking.
Yeah, I mean, change, to your point, change is always happening at the margin. It's not something that you want to look at absolutely or in absolute terms, but what is happening at the margins, because that's where the signal is at, so to say. And yeah, moving to more inelastic buyers is one thing on the demand side, which is sort of something where we could maybe say it's sort of deteriorating in that sense. And then on the supply side, we also have like stuff that's been changing, just like the sheer scale and size of the treasury market issuance. I think ever since COVID has really blown out. So can you map this out for us as well? And what exactly is the issue here?
Yeah. So since 2020, the Treasury's outstanding marketable debt has jumped about 13 trillion. So pretty significant. That's roughly half of GDP added in 5 years since COVID. Massive, right? And it's not like there's necessarily more buyers to kind of support that. And so, especially as you get this shifting buyer base, and as you're kind of moving into these more elastic, this buyer base from stablecoins, as I was mentioning, but you are going to then have the added pressure of now they need to absorb more of their marketable debts, and it's just you're getting it from the demand side, as you said, but they're also having to absorb more. So that is going to put pressure on the primary dealer balance sheets, because they've always kind of stepped in as a backstop, let's call it, for these auctions, kind of a buyer of last resort. They stepped in when as needed. Now with more that they have to step into, then that's more stress on their balance sheets. And so you're kind of getting a dual-headed dragon or double-edged sword, whatever analogy works best for you. Where you are getting it on both sides, and it's not only just the kind of the shift in the optics of it and the actual end user and buyer, but you're actually really seeing the pressure that started in COVID, and really just the sheer volume of debt that has been in.
Yeah, and who are these traditional dealers?
Your primary broker dealers, like your JP Morgan, your Morgan Stanleys, your Goldman Sachs. Um, it's the bigger banks that have the balance sheet capacity to do this. These are really the primary kind of firms. Your Citigroups. It's really these bigger banks with these desks that can manage it, because the Federal Reserve and the Treasury market, the Treasury needs somebody with the capacity to handle that. And you got to turn to the banks with the balance sheet and the funding and the ability just to absorb that kind of level, especially now.
Yeah. One thing that could help with balance sheet capacity would probably be a regulatory relief. I mean, this supplementary leverage ratio is something that's being talked about. That could potentially help offset this. Are we seeing any of this now, or is this just still just the talks of the town, but nothing is really like materializing?
So it's tiny bits of relief here and there. It's not an ad hoc basis where you're getting massive relief all at once. There's been some discussion of adjusting the SLR calculation, whether that's to exclude reserves again, but so far that hasn't been implemented. The real kind of relief is going to come in the form of basis trades, where it's hedge funds taking the inventory that dealers can't. Some people have been talking about this. You're seeing it in excess liquidity coming through ETF funding trades, stuff like that, where you're seeing basis trades happen to kind of where those dealers are pushing off some of that stress that they would normally have to buy side participants that think they can capitalize on these basis trades. So that's all well and good, right? Until you get a vol spike. And then you're going to have forced unwinds. You're going to get more repo pressure. So to your point, we need either stronger regulatory relief or a massive uptick in demand across the board from those natural buyers that had historically been there from the foreign buyer base. So one of the two is going to have to kind of crack, or there's going to be cracks in the market themselves. But yeah, right now it hasn't been anything that's come to fruition in terms of anything meaningful, and that's definitely an area where I think you need to continue to see, because that'll change the calculus, right? It's that if relief does come, whether it's in regulatory or demand, then that unwinds a lot of what we've already discussed here today.
Yeah. I mean, just offloading it to like elastic buyers, as you called them, it is just a short-sighted relief in that sense, because as you said, if we get a vol spike, then all of a sudden, like an inelastic buyer has to come in again. So in that sense, I cannot help but think that the Treasury or like the Federal Reserve at some point will have to step back in. And that's exactly what we started with, with the QT, that they sort of need to wind down, but then maybe at some point even go into something like QE again, which they will never probably call QE because that was sort of an emergency program. But I feel like with these shifts, tectonic shifts under the hood, I wouldn't be surprised to see it in 5 to 10 years time that the Federal Reserve would just own a lot more U.S. Treasuries on its balance sheet, similar to a place like Japan, where the BOG is already owning up to, I don't know, 50% of all government bonds, or what is your take there?
I am totally in agreement. I think, again, like you said, it's not necessarily imminent, but it is. If things don't change, you're going to have a buyer bigger than just the dealers can handle right now. I mean, you're getting some relief. It's a Band-Aid right now on a much bigger wound. You can only put so many Band-Aids on. You can only kind of plug the gap for so long before that pressure in the plumbing kind of bursts, so to speak. And yeah, you will have if nothing changes, if we kind of continue with this status quo of just accepting the Band-Aid and the temporary fix, you are going to have a situation where the Fed needs to step in. and kind of support some of this issuance that right now is being really warehoused by those dealers and being able to be warehoused by kind of that the basis trades with the funds. That's not an everlasting fix, and I think that's one of those things where it is down the road, but that's where you might see a structural change or a structural bid come in if it is the Fed or something else has come to fruition in the system that has kind of changed the landscape entirely.
Coming back to these cracks, that we're now discussing, one thing I want to ask you is I feel like many commentators have been calling for the deterioration and disruption of the treasury market or in the treasury market for years, but it still seems to be functioning just fine. Can you point me to any hard facts or data points that you can really share with us to prove that things are in fact deteriorating?
Yeah, sure. So that is one area I want to be firm about, and I think I've kind of hit on that today. Is I am not somebody who thinks this is going to blow up tomorrow, and I think you have had kind of doom and gloom around this exact topic for some time now. I mean, I can remember it going back years. One of the key things I'd hit upon is the breadth and the depth of these auctions. How much demand are you getting? So in the bid cover ratios back pre-COVID, you were somewhere around 2.7, 2.9 bid to cover. And that's, how many people are bidding at a certain yield to cover that issuance. And now we're seeing that closer to around a 2.3, 2.4. And so even that, it's meaningful. You're losing, 0.5 x the amount of demand and the breadth of that demand that was there only 5 years ago. And so that's kind of one of the first kind of areas that I look at is just how many people are stepping in and how many buyers are actually taking this seriously and want to be buyers of this market. And that's deteriorated to start with. And then you're also seeing just the tails themselves, meaning how much is the actual final yield that is accepted versus what it was when issued, because these are Dutch auctions. And so every buyer ends up getting the final yield. And so when we're seeing that tail more often, which we have been for the past year, past 12 months, we're seeing more tails. Not everyone, certainly not, but we're seeing it occur more regularly. That means that the Treasury is having to accept, bids on that from a lower yield, from a more price sensitive, from people that are not necessarily as demand driven as they've historically had to. And so we're seeing both of these things kind of occur at the same time. And that to me tells me that, something is up and that the buyer base is not as enthusiastic with treasury markets, whether that is a systemic wide view, whether that is related to kind of what's going on with the government themselves. It remains to be seen, but it's been notable that it's been happening for months. I wouldn't say you can't look at any one auction. You can't look at any kind of, even just a couple weeks. You want to see the trend. Again, going back to it's the trend, not the level. It's the change that you want to focus on. So as we're seeing, 40%, 45% of these auctions tail, and you're getting to a good amount of them over the course of 12 months, that's something to take note, because it means there's not as much demand as there historically was.
Yeah, I see. Very interesting. That's some good reference points for sure for people to track themselves. I mean, one thing that's sort of a dichotomy to me, or it's just sort of weird when I look at the treasury market, in some sense, I hear about there's a lot of issuance in the last few years, as we discussed as well, ever since COVID, this has sort of stepped up. Then there's this huge debt refinancing wall that's coming. And so a lot of issuance still has to happen. But then at the same time, I think treasuries are also in some sense scarce, especially on the run treasuries, the ones that are being issued right off the bat, and then you get this sort of bifurcation across the entire treasury market. But then again, what you're telling me is then that the natural demand might not be as abundant anymore, and that's really the problem that can lead to constrained intermediation. And for investors, this would then also mean, or what would this mean? Structurally higher volatility, or what comes with this?
Yeah. So I think the main point would be higher volatility and higher likelihood that that there's going to be unwinds, right? In any funding trade, any trade that really involves the treasury markets, you're going to see a potential for greater volatility because of that crypto transmission. You have this stablecoin buyer, and because stablecoins are still largely used to fund trades in the crypto market, now that's connected to the treasury market. That's historically never been the case. And the crypto markets obviously have a much higher volatility, typically a higher risk, depending on how you define risk, than the treasury markets ever had before. And so you're seeing these marginal buyers kind of come in and change the calculus and the math behind what you consider when you're going into buy these treasuries. Am I going to get unwound because there's a big funding pull from the stablecoin market? And so you're also seeing it. I will say that you're seeing a bifurcation between bill and bonds. You're getting this bid at the moment from these stablecoins that are at the short end. You're really getting this focus on kind of their money substitutes the bills, and stablecoins obviously have to be backed by shorter duration Treasury securities. But bonds are more of your balance sheet inventory, which is where we're seeing a lot of this stress. We're seeing the stress on these balance sheets from top to bottom. We're seeing it in the regional banks already. Eventually, if things don't change, we're going to see it in kind of these primary dealers who are already having to offload onto kind of the hedge funds out there that are stepping in for basis trades. But until QT stops and kind of reserves stabilize, until we see that halt, I think you're going to see this bifurcation and this divergence between kind of the two ends of the curve. And that in and of itself, mixed with the demand shift, I think is going to just increase the volatility. It's going to increase the risks of anything being pulled back too quickly and seeing unwinds that compound themselves.
Yeah. I mean, if I recall what my boss usually tells me, investment manager, he's like, I love volatility. This is something I live for, because volatility is vitality, as Michael Saylor would say, from strategy. But I feel like he's really like my boss. He says he's referring to the fact that this makes markets more interesting. And now I'm just trying to think out loud here. Is this maybe also an opportunity for savvy like bond traders, people who do understand these markets? The short, the long end, and then also the higher structural volatility. That this could actually be interesting. To trade more in and out of bonds, and this is maybe where bonds then also will have their place in a portfolio. It's not that they will be like, just you hold them no matter what. Maybe if you're 90 years old, then they make sense, but if not, you don't want to hold them, but you get more of this volatility, and so there's more opportunity to kind of benefit off of this. So any thoughts about this? Because I see this on X a lot, like people now calling each other out for like, why would you even write about bonds?
Yeah.
Why are you still in the bond trades? And others are saying, well, there's volatility. I like it. So to your point, that would sort of be water on the wheels of these guys, so to say.
100%. And I saw a couple of those tweets that I'm sure you're mentioning right now, where people are like, why would you ever even pay attention to bonds? And it's funny, as somebody who started kind of on my career on the equity side. The reason I pay attention to bonds, one, they're the most interesting market in the world, I believe, especially given how tied to everything the treasury market is. As I keep coming back to, the deepest market in the world. But I think more importantly, that volatility point that we were just hitting on, it creates opportunity, right? And that hasn't always been there. And yeah, like our parents, our grandparents, whatever that is, the older generations, yeah, sure, they have bond portfolios that they haven't touched, and they don't want to touch, and that's smart. Flip the coupons and go about your day. But you are seeing, as you get kind of these moves bubbling up from funding markets and filtering out through liquidity and through this shifting demand balance and through the oversupply, you're just going to create opportunities where you do see the curve move in a way that it hasn't beforehand. And I think that's exactly why you are seeing there's kind of a new age view that I've also seen on Twitter. You're seeing where some people are saying avoid bonds entirely, but there's a whole new kind of cohort, at least of people I follow, that are like, no, this is where things are happening. This is where it starts and ends, and this is where I want to be. And I think there's a lot of opportunity set there for sure. anybody who's, looking at things from a macro level, obviously your fixed income traders are already going to be focused on that. But I think it's a place where people should start to look more generally speaking, or, even if you're an equity portfolio manager, focus on how the move in the curve is going to affect your equity basket. If you're longer duration and you think long duration of the curve is going to underperform, then you might want to reduce your risk there, right? And kind of shift into the shorter duration equities, the more value-based names. So I think it's as important as ever to pay attention to, and I think it's probably as exciting as ever, given that things are changing for the first time in some time, especially since, the past 5 years with COVID, where things were a little bit easier, ample liquidity. There wasn't any of these kind of structural cracks that we're starting to see here and there.
That's great. Great piece of advice as well. Here and now, or time and time again during this interview, we're talking about the rewiring of capital transmission mechanisms through stablecoins, and you had this one sentence that I want to read out to you, and maybe you can elaborate how you arrive at this. But you wrote, although the daily data are noise, the broader trend underscores that the front end has become sensitive to crypto flows rather than traditional money market mechanics. I think you already hinted at it, but maybe if you can flesh this out again, why is this the case, and why can you make such a statement?
Sure. So it comes back to what I was talking about earlier, where we're at a point where stable coins are still being used primarily to trade crypto. Crypto is significantly more volatile than your traditional treasury markets. And now, given the connection of stablecoins to the funding markets, to the auctions, to the short end of the curve, you are now having a direct transmission between crypto and the treasury markets. And so that's where you are starting to see this risk of heightened volatility, of further collateral stress. You are getting a thing where you're seeing more repo fails, and dealer stress are only going to be amplified by the potential of a recall for crypto. If there's a massive, unwind in the crypto trade, generally speaking, we're already seeing, it happen to some degree in Bitcoin. But if we see that kind of shock the market across the board, you're going to see people unwinding their leverage through the stable coins that they were already using to kind of to implement those trades. And then now that has a direct connection to the traditional funding markets and to the treasury system.
Can you take me through the exact mechanism? It would be that stablecoin issuers who are mostly backed, so to say, with treasury market collateral, treasury like bills, short-term bills as we established.
Yeah.
Like if there was sort of this unwind, the danger would be that a lot of people would rush to the doors and try to redeem stablecoins for these treasury bills, and then for actual dollars, and then that's why treasury bills would have to be sold into the market, and that could then create sort of dislocations. Or what's the mechanism here?
Yes. So that is essentially exactly it. So it's the people who are funding their crypto trades through borrowing through the stable coins, which are then connected obviously to the bills. And it's a massive rush on margin calls, so to speak. And when people are hitting their limit, or they're getting forced liquidation, then that would then play directly into it as they unwind every part of that trade. As they liquidate the crypto, then they have to then get their stable coins back. And given the risk, then you could see an unwind from the stable coins back into the treasury securities, back into cash. So all of that happening at once, and especially if it were to happen in kind of en masse, that is going to then put added stress on kind of that bill marketplace, and bringing that volatility. That's kind of exactly it. It's through the chain link of those where you see volatility starts here, and then as every part of that trade begins to unwind, that's where it could then show up and be transmitted all the way through to the end for those bills. Go on, please.
Yeah, and do you think we've seen some of this already happening? Because like just last Friday, we had this huge deleveraging event throughout all of crypto, like almost, I don't know, 50 billion in open interest was vanished, and then also a lot of liquidations. And do you think we've seen some of these spillover effects happening there already?
Yeah, I think.
Or was it too weak of an event? Or
I would say it's still maybe not large enough to see it in any super meaningful way. But I think we probably saw some of that translate this week into what we've seen in funding markets and kind of what we've seen in the treasuries, in the bills. And I think this liquidation event that we had last weekend or a week ago was very large for the crypto market cap, but you have to kind of see how that pairs to the treasury markets and kind of the whole mechanism there. I don't think it was enough yet to really move the needle to the point where we're seeing it and you're slamming the panic button. But I do think as crypto continues to grow and as, potential further liquidation events like this happen, I think it will absolutely start to filter through and kind of be seen in these funding markets. But yeah, I don't believe that we saw it in any meaningful way yet. But I would say maybe at the margin, again, going back to just a little bit of change that probably played into some of what we saw this week, especially with the Fed announcement, the ampleness drying up, and so it's a thing where you have to kind of understand the difference in size and the scope of the two markets themselves right now. But as one grows and as the demand for the other one changes, then that's only going to worsen.
Yeah, we're back to square one, or at the marginal thinking that we were referencing. Like it's really all about the margins, and maybe we saw here and there already some stuff happening, and we don't know if any like also dead bodies will surface in crypto, and then maybe also like out of crypto. But I mean, if I take these thoughts and I spin the wheel, further into the future, it sounds to me that crypto will ever become more this systemic risk for U.S. Treasury markets through this stablecoin transmission mechanism. And this then also sort of even makes me think, doesn't this mean that Bitcoin has US policymakers by the throat at some point? Ironically speaking, if there was a systemic risk event in Bitcoin, policymakers would need to step in to prevent destabilization of the treasury market because of these spillover effects, which is sort of perverse and ironic because Bitcoin could even, as I said, have them by the nuts, and the treasury markets would have to intervene and that way again sort of strengthen the case for Bitcoin, because then if you intervene and you have sort of these interventions monetary wise, this would then again like further the cause of Bitcoin, because there more debasement is happening because of Bitcoin. So it would be kind of a weird world if we think about it.
100%, and that's like the way I always try to think about things. And I've touched upon this as I was walking through kind of the treasury market and how that then will apply to various levels of your equities. And I think everything you have to think about is feedback loops, right? And right now with crypto, we are starting to see what you just kind of discussed, where the more adoption there is in crypto in general, and the more adoption there is for stablecoins, the larger that risk of kind of a bleed through to the funding markets, to the treasury markets, the bigger it becomes. But that is also kind of saying that nothing else changes, right? And so I think that's where you have to tie in policy changes, any release that we're getting, any kind of a shifting landscape in general that maybe we're not even thinking about. I mean, 10 years ago, I told you that crypto was going to have an effect in treasury in even any capacity, you might have said I was crazy, but 10 years down the line, I think we'll see it has an even bigger effect to some capacity as we start to get more upkeep and more adoption. And we're already seeing, big institutions, financial institutions come out and kind of adopt stable coins and kind of throw their hat into the ring. And the more that occurs, the more connects that linkage and more strengthens that linkage between the crypto demand and the treasury market demand. And that's where you're going to see this volatility and potentially these feedback loops where one thing triggers on one end and you kind of get a domino effect coming all the way through down to what was historically the safest markets in the world.
Yeah. Yeah. Crazy. Well, Bob, I think we're coming up on the hour here. So that was amazing. Thanks a lot for sharing all these insights with us. Maybe just to finish up, again, where can people find you? And also maybe what's the next article that you're already planning, that you're working off? Can you already give us a sneak peek here? Or
Sure, yeah. So you can find me on lighthousemacro.com. I'm also on Substack through Lighthouse Macro. Look me up there. I'm also on Twitter at LHMacro. You can find me on all three. I'm always welcome to answer DMs. I'm happy to chat markets with anybody. So please feel free to reach out. And in terms of next steps, I actually was going to write an article kind of talking about a lot of what we talked about today, as well as I do want to touch upon the labor markets right now. And I think kind of the wage price spiral we're seeing, and sort of the connection between all of that and tying labor and wages and inflation kind of back into this whole funding world that we're living in and this shift towards fiscal. So that's kind of where my next brainchild will be coming from.
Nice, amazing. Looking forward to this one as well. So I'll be a reader for sure. So Bob, yeah, thanks a lot for doing this. We'll surely have to get you back on to talk plumbing and markets again. And yeah, just enjoy the rest of your day.
Yeah, thank you so much. This has been awesome. I'm so thrilled to have been asked to be on this, and I'm excited to continue moving forward. Hopefully, I'd love to be back someday, and hopefully, in the meantime, you enjoy what I'm putting out.
Yes, thank you. Have a good one. Bye.
Thank you. Bye-bye.